Welcome to this explainer. Look, if you're managing institutional capital, family office wealth, or steering massive asset allocations, you already know the old playbook is basically out the window for 2026. This year presents a genuinely fascinating collision. Massive, structural technological innovation is crashing right into heavy, cyclical economic realities. We are completely out of the zero interest rate environment of the past, and navigating this profoundly bifurcated market means we have to aggressively rethink our risk management frameworks and reevaluate where true alpha actually lives.
And that brings us to the absolute core tension of the year. Picture a massive tug-of-war. On one side, we have this incredible structural lift, the sheer, unprecedented force of artificial intelligence actively trying to boost global productivity and corporate margins. But pulling hard on the other side, we've got severe economic drift caused by cyclical burdens like new global tariffs, sticky inflation, and frankly, soggy baseline economic growth. The defining risk management challenge for all of us this year is figuring out which of these forces wins out in your portfolio and how to capture the upside of that lift while firmly hedging against the drift.
So, how do we make sense of all this? We're going to break it down into 6 parts: the macro landscape, the AI boom, crypto's new institutional era, global equities, fixed income risks, and finally, rebalancing the modern portfolio. Let's jump right in.
Starting things off with Part 1, the 2026 macro landscape.
Okay, so right off the bat, we have a massive shift in our planning horizon. The newly enacted OB3 Act just permanently cemented certain tax rules that were previously set to expire. We are now looking at a permanent 37% top tax rate, a huge $15 million estate exemption, and a permanent 20% qualified business income deduction. For institutional managers and private wealth advisors, this is huge. It completely removes a massive layer of legislative uncertainty that's been hanging over us. It really opens up long-term strategic wealth transfer opportunities, meaning capital can now be deployed with much higher conviction over multi-decade timeframes.
But, and this is a critical but, beneath those high-level institutional wins, we're looking at a deeply K-shaped economy. While institutional wealth grows under these stable frameworks, middle-income workers are feeling immense pressure. Survey data shows retirement confidence has plummeted to just 64%, totally driven by persistent worries over sticky inflation, rising consumer debt, and astronomical housing costs. From an allocation perspective, this divergence means we have to heavily scrutinize the consumer discretionary sector. Luxury brands still have incredible pricing power, but middle-market retailers are facing serious margin compression.
Moving right along to Section 2, the AI investment boom.
You honestly just can't ignore the sheer volume of venture capital flooding into this space. It's staggering. And it's not just going into large language models, the big computational engines of AI. Massive capital is surging into highly targeted, sector-specific applications. We're watching a structural transition moving at breakneck speed. VC is aggressively funding both the core foundational infrastructure and the everyday operational tools built on top of it. This is so much bigger than a tech trend. It's literally a fundamental rewiring of corporate productivity across the entire economy.
Now, to dodge the severe concentration risk of just holding a handful of mega-cap tech giants, smart money is looking way beyond the innovators. It's the classic gold rush strategy, right? Sell the pickaxes. Institutions are targeting the enablers. Think industrials and utilities, providing the massive grid power needed for data centers or advanced cooling manufacturers. Plus, capital is pouring into the adopters, like massive financial institutions and healthcare networks, using AI to slash headcount and radically boost margins. That is absolutely where the stealth alpha lies right now.
Here's a stat that might actually surprise you. This technology is democratizing incredibly fast. A whopping 62% of retail investors are now using AI tools to inform their trades, and 65% of them are reporting measurable improvements in their performance. For us on the institutional side, that means our historical informational edge is eroding. Retail is leveraging financial-grade AI to parse earnings calls and model valuations in real time. It's forcing institutions to dive much deeper into private markets or complex structured products to find returns that aren't instantly arbitraged away by retail algos.
Shifting gears to Section 3, crypto's new institutional era.
If you still think of crypto as a retail casino, it's time to update your priors. Analysts across major institutions now agree that the old, hyper-volatile retail halving cycle is officially dead and gone. It's been replaced by a totally new era of stable, sustained institutional value growth. This maturity is driven by clear compliance frameworks, rock-solid custody solutions, and seamless integration into mainstream capital markets. Emotional retail speculation has been replaced by systematic institutional rebalancing.
Crypto has undeniably crossed the Rubicon into a deeply audited, strategically viable asset class. $50 billion. Let that number sink in for a second. That staggering figure represents the massive influx of core institutional capital expected to flow into spot cryptocurrency ETFs in 2026 alone. We're talking sovereign wealth funds, state pensions, and massive endowments finally stepping onto the playing field. As risk managers, there's just no way we can ignore that level of market depth and liquidity anymore. It's officially functioning like digital gold, a liquid, non-correlated hedge against fiat debasement.
Which brings us to Section 4, Global Equities and Alternatives.
For years, the U.S. has basically eaten everyone's lunch when it comes to global returns. But that historically wide earnings gap between U.S. and international companies, it is closing fast. U.S. earnings growth is projected at 11 to 13%, but international markets are right on its heels at roughly 10%, and the valuations abroad are significantly cheaper. Thanks to positive nominal growth, the end of negative interest rates, and a massive wave of shareholder-friendly buybacks across Europe and Japan, international equities present a seriously compelling risk-reward profile right now.
Now let's talk defense in Section 5, Navigating Fixed Income Risks.
Because of that sticky inflation and a surprisingly tight labor market, the Federal Reserve is walking a very cautious, shallow easing path this year. Short rates are likely going to hover in the mid-threes, and we're only expecting about 2 to 3 shallow rate cuts through the entire year. What does this mean for risk management? Constant rate volatility. The market is going to continuously reprice Fed expectations. Any corporation facing a refinancing wall is going to feel a serious squeeze, making your credit selection absolutely critical.
To survive this sustained volatility, passive bond holding is pretty much off the table. The new fixed income playbook demands highly active duration management. You have to tactically balance short-dated securities for yield with intermediate ones to hedge against growth shocks. You definitely need TIPS, Treasury inflation-protected securities, to build a firewall against inflation. And frankly, risk managers are leaning heavily into the tax-equivalent yields of high-quality municipal bonds right now, especially with those permanent tax brackets we talked about earlier, alongside global sovereign debt to diversify away from domestic risks.
Let's bring it all together in our final section, Rebalancing the Modern Portfolio. It's time to face facts. The traditional 60-40 portfolio is essentially dead. To actually thrive in this high-friction environment, allocators are shifting to what we're calling the 60-40 plus. This means intentionally carving out a dedicated 20% slice of the pie exclusively for alternative investments, private equity, venture capital, real estate, and crypto. Capturing that illiquidity premium is absolutely crucial to reduce your correlation to wild public markets and to grab the massive private market alpha being generated in spaces like AI and digital infrastructure.
So how do we practically get our portfolios on sides for all these macro shifts? It boils down to 3 core steps. Step 1, broaden your equity exposure way beyond just US large cap tech. Step 2, abandon passive bond indexing and actively manage your fixed income duration. And step 3, allocate meaningful capital to private credit and equity to capture the innovation premium. Executing these 3 steps ensures your capital is structurally engineered to ride the AI boom while weathering the macroeconomic drag.
I really love this guiding philosophy from JP Morgan Asset Management. Diversification isn't dead, just different. It totally hits the nail on the head. The fundamental rule of protecting your capital and generating compound returns hasn't vanished. It's just evolved. Today's diversification can't just be buying the S&P 500 and an aggregate bond index. It has to include entirely new asset classes, deep global perspectives, and highly active tactical management.
Which leaves us with the ultimate question you have to ask yourself right now as an allocator. Is your portfolio structurally ready for 2026, or are you literally still investing for the last decade? It's time to take a hard, objective look at your allocations, implement these institutional risk strategies, and make sure you're positioned to capture the alpha of tomorrow. Thanks for hanging out with me for this explainer, and I'll catch you in the next one.